I believe that the jobs report we got today is potentially a watershed moment, not just for the stock market, but for the US economy as a whole. So I thought it made sense to do a video telling you my thoughts now that that job report has been released. Welcome to the Stock Sale Flyer. My name is Aaron. None of this is financial advice and it's all time sensitive. Let's get into the jobs report. So I said earlier this week that I thought that the jobs report we got today would likely be the most important thing that happens in markets this week. I posted this on X earlier this week, and I still believe that. We got this jobs report today, and it showed that hiring and wages are up, as it says here from the Wall Street Journal, reinforcing the economy's resilience. And this was the narrative in the news. Look at how strong the U.S. economy is with all these jobs. The wages are up. But on the other side, we had the unemployment rate ticking up, as it says here, to 4%. So unemployment is seemingly on the rise, or it is on the rise, but the economy looks like it's still creating jobs and that wages are going up. So the question here is, can the Federal Reserve thread the needle? Are we going to get rate cuts at the right time or the wrong time? And I think that it's going to be difficult for the Fed to thread the needle and get, that soft landing that people have been talking about for a long time. It is possible, but we're getting closer to a resolution here, I think. I think the market had a hard time digesting this jobs report, kind of like I did, thinking, is this a good thing or a bad thing? Because I was watching it trade today. I was watching the market trade today, and it was kind of chopping around. It kind of went sideways for a lot of the day. And I think that might be illustrative of the fact that I was not the only one trying to figure out, wait, is this jobs report really a good thing? Or is it not a good thing because the unemployment rate is now on the rise? And obviously, people have been talking about rate cuts for quite some time now, but inflation has remained sticky. So the Federal Reserve has not felt like they were able to cut rates. The question now, with unemployment hitting 4%, what does that mean for rate cuts when you also have growing wages, which could lead to more inflation, and you have strong hiring? You're kind of getting two different sides of the situation at once here, and the Fed's going to have to figure out what to do. And if they get it wrong, it could have consequences either in rising inflation again or in a recession. So if they cut too early, then you might get rising inflation again. If they cut too late, you might get a recession. You might get an increase in the unemployment rate that really spirals a lot more. And you're seeing both of these things start to pop up in the news, right? So here's another headline from the Wall Street Journal from June 1st. The Fed might soon have to worry about more than just inflation. As evidence mounts that the economy is slowing, pressure to lower rates could build. So we have this story of the economy is slowing down, and we also have this story of the job market is really strong, hiring and wages are up, the economy is resilient. So which one's going to play out? What I think is interesting is, this was on X from at Meat Blossom app, the history of the unemployment rate. This had me go and get this chart. The source is the US Bureau of Labor Statistics. But I find this interesting because, as you can see on this chart, a lot of the time when the unemployment rate does start to tick up and accelerate, it accelerates. And you can see the gray areas on this chart represent recessions. So this, I think, illustrates how difficult it's going to be for the Federal Reserve to get this correct, either in one direction or the other. Again, do they cut too soon, too late, or can they get it just right and get that sort of Goldilocks scenario? It's going to be difficult, I think, for them to do that. But that is this question. Can they orchestrate this soft landing? And if they can't, I am concerned in both ways. I don't want to see inflation on the rise again. That could get, that could be a really bad situation for a lot of people. But I also don't want to see the recession on the other side. And what concerns me, no matter what we get, is I don't think either one of those situations in the short run is going to be good for stocks, especially with market valuations the way they are right now. There are some people who think that, the market is not as overvalued. I know that I'm having a more difficult time finding value in the stock market. And you look at some of these sort of controversial different indicators like the Buffett indicator. So this is from Guru Focus, the Buffett indicator. Where are we with market valuations? The stock market is significantly overvalued according to Buffett indicator. Some people don't like the Buffett indicator. It's basically total market cap over GDP. So total market cap of the stock market over GDP. Then you have, it says here, meanwhile, based on the historical ratio of newly introduced total market cap over GDP plus total asset of Federal Reserve banks, they're still saying the stock market here is significantly overvalued. You've got the Shiller PE ratio, which here it says Shiller PE, a better measurement of market valuation. This is also from Guru Focus. Shiller PE is 34.5. Shiller PE is 30.3% higher than the recent 20-year average of 26.5. So you look at these different metrics for trying to value the stock market. A lot of them are saying that the market is overvalued. Not everybody agrees with that. I think the market's overvalued personally. I think it's more difficult to find value in the stock market right now. So that means if the Fed does not thread the needle, if I'm correct that the market is overvalued and it doesn't have time to grow into those valuations, that means that stocks have a lot more room to come down, which means a lot of losses in the short term. Now, I'm not saying this is going to happen, right? I can't predict the future. I'm just looking at all the information, and it gets back to why, for me, I'm interested in being able to value things and know what I'm paying for something. And sometimes I'm going to be wrong, but I don't want to buy things that are overvalued, because if I do that, that means they have a lot more room to fall when things finally do have a reason to fall, like rising unemployment leading into a recession, or on the other side, difficult economic situations for people eating up more of their capital so they can't invest it because of inflation. Both of those things can have a negative impact on stocks. So, that's really what I'm trying to do on this channel, is value companies and look at valuation. So if you haven't checked out what I'm doing over on this channel yet, come check out some of the valuations and companies I've done. I would not buy something because I bought it or because I say it's undervalued. If you don't have your own process, I wouldn't even invest in individual stocks. Really, I'm saying this as a warning because a lot of people, I think, with the way the market's going, are excited about things like Nvidia and GameStop and these different stocks that are soaring, and they're jumping into these individual companies. And if you don't have a process for how you're going to value these things and see what they're worth, you shouldn't be buying them. Just like you shouldn't go to the grocery store and pay $100 for a rotisserie chicken. For most people, I think index fund is the way to go. But if you're interested in learning something about valuation, come check out what I'm doing on the channel, at least for entertainment value, right? And I hope it's helpful. So follow me on X at Stock Sale Flyer, click the like button, subscribe, click the bell to get notifications, drop comments, let me know what you think. Really trying to be helpful on this channel. So always do your own research, always do your own due diligence. But I hope that you enjoy what I'm trying to do here. And those are some of my thoughts on the job report and the market and the economy as a whole and where we're going. I think it's a watershed moment. So we'll see what happens. Take care. Bye.